the bottom line is gold is holding its own. It still buys a hell of a lot more than it did 20 some odd years ago. And I do think it will turn up. Maybe not this year, maybe not new highs this year, but I certainly think we're going to be done with the Fed's rate hike tightening cycle or rate hike cycle this year. And next year, when they pause, it should be positive for gold. When they pivot, it's going to be incredible for gold. And I expect much better things for gold in next year.
Gold prices hovered near one-month highs on Thursday as the dollar and Treasury yields fell on expectations that the U.S. Federal Reserve could end its rate hike cycle soon. The dollar index fell to its lowest in over a year, making gold more affordable to overseas buyers. In contrast, benchmark U.S. Treasury yields fell, reducing the opportunity cost of holding non-yielding bullion. According to Rich Checkan, president and co-founder of Asset Strategies International, gold is holding its own and still retains significant purchasing power compared to 20 years ago. While he doesn't expect gold to reach new highs this year, he does anticipate that the Federal Reserve's tightening cycle will end, which should be positive for gold. Prices are going to be range-bound near term. If the Fed begins to say we don't need to raise rates any further, we can see gold rise further, said Daniel Pavlonis, senior market strategist at RJO Futures. Checkan also believes gold's price will increase over time due to the inevitable need for currency inflation. Rising bond yields, a strong U.S. dollar, and the belief in the Fed's commitment to raising interest rates all pose challenges for gold in the short term. However, Checkan emphasizes that despite these headwinds, gold has proven resilient and cannot be easily beaten down. Speaking with Kitco News, Checkan also discusses the premiums associated with silver eagles, which are 1-ounce silver coins. He highlights that these premiums were previously high, ranging from 50 to 60%. However, he mentions that these premiums have started decreasing, although they remain relatively high. On the other hand, the premiums for 1-ounce gold coins, such as gold eagles, have declined, providing buyers with more value for their money when purchasing these coins. Now let's watch excerpts from Rich Checkan's interview with Kitco News. Before we get started, make sure to smash that subscribe button and remember to enable post notifications to stay updated on our latest uploads. Thank you and enjoy the video.
Basis what I just said about the Fed having no other alternative but to inflate the currency, there's no question in my mind that gold goes up in price over time. The question is, will it keep up short-term, medium-term, long-term with other asset classes? The chart says, the Dow's up 198% in 20 some odd years, 23 years. S&P 500 is up a little over 202%. NASDAQ's up 230%. Silver, up 327% in the 23-year period, and gold's up 562%. Long-term, gold would do its job. I wonder about the valuations of these companies and how, when greed leaves the equation and we shift back to fear, and we will, Michelle, we always do. This is fear, greed. It keeps handing off the baton. And when that happens again, I think gold holds its value or increases, and stocks will pull back. And that may be that soft, hard, painful landing that we're looking for. There will be a recession, and that doesn't mean stock prices keep going up. And most analysts are saying that we will not see new record highs this year. Most of the analysts out there are saying that we've already seen it. Earlier in the year, this year, the high price for the year. A handful are still calling for that $2,400 level. I don't know if I'm in that camp right now, and it's not a bad thing. Again, gold is going against significant headwinds right now. The rising yields on bonds, the strong, if you will, U.S. dollar, although I don't know, falling from 116 to 103 in less than a year is strong. But it's running into some headwinds. You've got the belief in the Fed and the fact that they will continue to raise interest rates. All that is negative for gold in the short term. And yet, you really can't beat it down. On the silver side, you look at silver eagles, we were looking at premiums of 50 to 60%. That means you have to buy 1.6 ounces of silver every time you wanted one. It's crazy. And yet people would pay those premiums, even though we try to talk them out of it and into other ways to own it. now those premiums are coming down. I don't have them off the top of my head, but I want to say we're approaching the 40% level, which is better, not great, but better.
Okay.
For 1 ounce gold coins in a quantity, a realistic quantity of 10 coins or so at a time, they were 15%. For Eagles. Now we're seeing them down around 8-9%, even lower if you can get deals on them from time to time. So we are seeing the premiums come down, and the snag always has been when we've had low spot prices, the premiums were higher than what they were when we had lower spot prices, and in the end, you're getting the same amount of gold for your money. Now you're starting to get a little bit more value for your money, and I think it's a good combination for buyers.
Moving forward, Checkan does not believe that we are currently in an inflationary environment for assets. He points out that assets like the Dow, S&P, NASDAQ, and Bitcoin experienced significant declines last year, ranging from 15% to 66%, while gold remained relatively stable. In fact, gold outperformed the NASDAQ by 30% and Bitcoin by 66%. Checkan believes this is because we are currently in a deflationary environment where the prices of goods and services are falling. This means that the purchasing power of money is increasing, and gold is a valuable asset in this environment because it can help to preserve purchasing power. He sees that this year's performance might need to reinforce gold's case more strongly. However, Checkan believes that gold has demonstrated its ability to retain purchasing power in the past. Let's get back to the interview.
Last year, I don't think we were in an inflationary environment for assets. Okay. My personal opinion, and I wrote about this a lot, is, that we were in a CPI, a consumer price inflation mode for all the things we're buying with our money. But our assets were in a deflationary mode, right? As the Fed was pulling the punch bowl away from the party. So in a deflationary environment for assets, gold actually did a fantastic job. I don't know if you recall the numbers of how far the Dow, the S&P, the NASDAQ, Bitcoin were down last year, anywhere from like 15 or 20 to 66%. In those range of assets. Gold was flat. Okay, and that doesn't sound like a lot, but it outperformed the NASDAQ by 30%. It outperformed Bitcoin by 66%. In a deflationary environment, gold's job is to hold purchasing power. I think it did that well last year. I don't know that it's really reinforcing its case with its performance this year and generating the comments from some of our clients. But, basically when he said, gold is not keeping up with inflation, I have to disagree. I think a lot of people give the Fed a lot of credit right now, and they believe that they have matters under control. Again, I see chinks in the armor. I see cracks in the foundation of the economy. I'm not saying it's the end of the world as we know it. I'm not a Chicken Little, the sky's falling type guy. I believe it or not, I am kind of an optimist, and I think we'll get through this. But I think there's more damage to the economy than they're letting on. I think the masses aren't seeing it. The confidence level is up, and they're believing what the Fed tell us, despite the fact, a Fed that has been wrong for so long, to have credibility in anybody's eyes is just beyond my comprehension. But for whatever reason, we're buying what they're selling, and people are buying into that. But I just don't think they have much further they can go with a $32 trillion debt, no cap on how high that can go, and the cost of basically servicing that debt going forward at these interest rate levels. The end of the road is near, and that's going to be a good time for anybody who's already purchased gold. At this point, there are people circulating with lists of banks that are in trouble, basis stress tests. So, yeah, I think that's happening. It's getting back to the credibility issue. I'm glad you brought up the banks. That's the Fed's oversight. It's one of the things they're supposed to be doing is regulating and monitoring the banking sector to make sure it's healthy. And they actually looked at these banks prior to them failing, and they missed it. Again, incredible credibility with the Fed. I don't get why people believe what they're selling. But yeah, I do think there's more bank failures coming. I don't know how the economy absorbs people walking away from trillion-dollar mortgages on a multiple basis. And it survives without pain. I don't know how that happens. Today, expensive gold is $1,800 to $2,000 an ounce. Gold is doing its job. And if you ever doubt that, all you have to do is zoom out. Okay, stop looking at the day-to-day, week-to-week, year-to-year chart. Zoom out and take a look at gold's performance versus the dollar versus the euro versus whatever over time. And there's no question about the trajectory of the gold price and whether or not gold is fighting inflation for your portfolio. It's a fantastic hedge.
Gold prices are expected to remain range-bound in the near term, but could rise further if the Federal Reserve begins to signal that it will end its tightening cycle. However, rising bond yields, a strong U.S. dollar, and the belief that the Fed is committed to raising interest rates all pose challenges for gold in the short term. Do you think the Federal Reserve's tightening cycle will end soon? How will this affect the price of gold? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.